Hi and welcome again to Excel's Master Course. In today's session you will give you a purview about the financial analysis. Are you ready? Finally guys! We did it! Now we have 2,000 subscribers. Thank you so much. We will do our best to you. Let's talk about the financial concepts and metrics. We gonna talk about it again in details in the financial analysis course. Let's talk about this major in general. Financial analysis is the process of evaluating the financial performance of a company or project. It involves examining the company's financial statements, such as the balance sheet, income statement, cash flow. Financial analysis is used by a variety of stakeholders, including investors, creditors, and managers. There are many different roles involved in financial analysis like financial analyst. Financial analysts are responsible for collecting, analyzing, and interpreting financial data. They use their findings to create reports and recommendations that can be used to make informed financial decisions. And also investment analysts research and evaluate potential investment opportunities. They use financial analysis to assess the risk and return potential of different investments. And also credit analysts. They assess the creditworthiness of borrowers. They use financial analysis to evaluate the borrower's ability to repay a loan. And also risk analysts. They assess the risks associated with different financial investments and decisions. They usually use financial analysis to identify, measure, and manage risk. Now let's talk about some financial concepts, calculations, and metrics. Present value, PV, is the current value of a future sum of money, discounted at a given interest rate and number of periods. For an example, if you are investing $100 today, at an interest rate of 5% per year, the PV of the investment is $95.24. This is because the $95.24 will grow to $100 in 1 year at an interest rate of 5%. Now let's talk about future value, FV. Is the value of a present sum of money in the future, given a certain interest rate and number of periods. For example, if you invest $100 today at an interest rate of 5% per year, the future value of the investment in 1 year will be $105. Now let's talk about the net present value, NPV. Is the difference between the present value of all future cash inflows and the present value of all future cash outflows. A positive NPV indicates that the investment is likely to be profitable, while a negative NPV indicates that the investment is likely to be unprofitable. Now let's talk about internal rate of return. Is the discount rate that makes the net present value, NPV, of a series of cash flows equal to zero. In other words, it is the annual rate of return that will be earned on an investment or project. An investment requires an initial investment of $100,000 and is expected to generate cash flows of $20,000 per year for the next 5 years. The ROI of the investment is 20%. This means that the investment will earn an annual return of 20%. Now let's talk about interest rate. The interest rate is the percentage of a loan or deposit that is charged or paid as interest over a period of time. It is typically expressed as an annual percentage rate, APR. Interest rates are determined by a variety of factors, including the supply and demand for money, the risk of the borrower, and the central bank's monetary policy. Interest rates can be either fixed or variable. A fixed interest rate remains the same over the life of the loan or deposit. A variable interest rate can change over time, typically in line with market interest rates. Interest rates play an important role in the economy. They affect the cost of borrowing money for businesses and individuals. And they also affect the returns on savings and investments. Here are some examples of interest rates. Prime rate. The prime rate is the interest rate that banks charge their most creditworthy customers. Mortgage rate. The mortgage rate is the interest rate that borrowers pay on a mortgage. Let's apply what we have learned in this session to the Excel. In this data set we have these data: cash flow and number of period and interest rate. And we gonna calculate these metrics: present value, future value, and net present value. Let's starting by the present value. So equal PV. Open parenthesis. Rate is the interest rate. And this NPER is summarizing for the number of period. And this PMT is summarizing for the payment, or in this case the cash flow. The negative sign in present value is normal because that indicates about the cash flow in the investment. Let's calculate the future value. It is the same. But don't to forget to classify the type. 0 is ending of period. And 1 is beginning of it. We need to make Excel recognize that it is the beginning of the period, so we gonna type 1. And now let's calculate the NPV. We gonna learn you the formula only. But in the real world it is a little bit different. Because the limitations of our data. When we launch the financial analysis course we will talk about those metrics again and more in details and provide real world example.